And where we're sitting today, arguably Canada and the U.S. is sitting between Group 7 and Group 8, which on average is forecasting about a 6% return. And I would agree that if we were to forecast what's the likely return to investors over the next decade, it would be roughly 6, give or take. And I'll give you some more evidence about that going forward in the package. But that the price you pay has a significant impact. And so that's one of our focuses. We want to go out there and try and buy stocks that are trading inexpensively and have a chance of getting good long-term returns. But if you accidentally buy expensive stocks, you might get lucky, but more often than not, the weight of history suggests you're likely to get poorer returns in the long run. And I need to speak a bit about relative value because in any market you get what you're faced with. And I'm a Canadian equity market specialist, the entire firm is. And every market is idiosyncratic, and the Canadian market is the most resource exposed of the major markets in the world. It has significant weight in oil and gas. And all markets are fairly idiosyncratic. But the style box matrix of investing that was developed that people notionally talk about, like, somebody gets put in the box of large cap value or small cap growth. That matrix was developed in the U.S., which is one of the biggest, deepest, broadest markets in the world. And it's possible to find enough diversity of names within those quadrants to build fully diversified portfolios and play those boxes for investors. But in more idiosyncratic markets like Canada, it's much harder to practice that. And I would argue that in Canada, to play large cap value solely throughout a cycle, you could have a very distorted portfolio. It could be very divergent from the overall broad market and would be fully weighted in cyclicals at one point in the cycle and underweighted cyclicals, and would look very risky in the middle for investors. You could have long, dry spells of underperformance. So we migrated to what we call relative value investing, where we try and match the market in terms of sector weights at all times, and then use strong stock selection within each sector to get better low-risk returns in the long run overall. And we've shown that through time. So we get the same long-term results as deep, deep value managers, but we don't tend to have such long, dry spells of underperformance in the middle that make investors really wonder whether their manager has mojo. So we talk about that in a little bit more depth in the book.